Welcome. My name is Van Richards. I'm a chartered financial consultant, and today we're talking about one of the preeminent academic publishing companies, that is John Wiley Sons. So let's go ahead and begin with today's daily stock analysis. Thank you for joining me today. If this is your first time, go over and hit the like button, hit the subscribe button, whether you're listening to this live, whether you're listening to it on a recording, whether it is a video or a podcast. I come to you on a daily basis and bring you great information on companies that you might not have heard of. And today we're talking about one of those companies, which is actually a small cap company called John Wiley Sons. Now, before we begin into that today, I want to tell you that today's program is sponsored by Richards Financial Planning. If you are frustrated on where the direction of your finances is going and you need help, go over to richardsfinancialplanning.com and learn more about the prosperous planning process. It's something that I think you'll be well rewarded for. Okay, let's go ahead and begin talking just a little bit about John Wiley Sons. I think that it is so important that people understand what they are investing in rather than just investing in a stock symbol or just say I'm investing in a particular stock. Know what the company does. So let's talk about that just a little bit. John Wiley Sons ended up the day about 1.63% at about 40. It says on the screen, if you're watching, at 48.50, but it was really just a hair below that at 48.49 when it ended. Now, the company in itself, what they do is they provide academic journals, books, pre and post hire assessments, and online education programs. The pandemic has actually benefited John Wiley Sons. 80% of their 2020 revenues was from digital products and tech-enabled services. 52% of their business is here in the United States, but they also have a significant footprint in the United Kingdom and Germany. They also have influence in other different countries, but in those other smaller countries, it's going to be less than 5% of their total sales. John Wiley Sons, in my opinion, really is a company that bridges the gap in between academia and industry with their services. It's a small company, but they're a big player when it comes to the type of products that they have. And we're going to talk about that more detail as we go through this information today. The company is considered, as I mentioned, a small cap company. A small cap company at $2.67 billion. And remember that when we look at a company, we do three things. We look at the stability, the earnings, and the competitiveness of that particular company. And the first thing that we try to look at all the time is going to be the moat of a company. A moat, Warren Buffett popularized this particular term. And he terms it as the moat is going to be that invisible barrier between the company and their competitors. I call it their superpower because it's what sets them apart from other companies and allows them to prosper. Now, with John Wiley Sons, actually, I think that they have three moat characteristics. The first one really is going to be proprietary assets. Now, their proprietary assets are really in publishing. They have a significant library of leading journals. And without those journals, some libraries, some universities, and some research institutions really would not have any place to publish. And that makes it a very big point for them. Now, switching cost is a big deal with anything. You know, it's the cost of going out and doing another service. And it's not just going out and finding another publisher for this particular company. If a company wants to compete with John Wiley Sons, they have to be entrenched into academia. John Wiley Sons helps universities with degree programs, research publishing, and then corporations and industry with assessment programs. it's not something that you can just go out and start doing tomorrow and you're going to automatically replace this company. So they are truly, in my opinion, a one-of-a-kind type company. Now, the third Moat characteristic, I think, is going to be the cost advantage. Now, as I talked about all these different publishing papers, if you've ever done some research, I don't pick whatever subject you want to pick, and you've looked it up, it's kind of, sometimes it's obscure. It might be, you might be researching moats, you know, the kind that go with castles, and you want to find information about it. There's a small audience for that. It's hard to be a competitor, to be a company that comes in and competes with John Wiley and Sons. Now, as I look at a company, and I remember, we're talking about what makes this company more stable. And I think that it's really important that you learn a little bit about the ratios, the financial ratios, when you're investigating a company. I don't want to get too geeky on you and get too nerdy with numbers, but there's two ratios, two or three numbers that I want to teach you about real briefly. The first one's going to be the debt equity ratio. This is a ratio that indicates the proportion of equity and debt that's used to finance assets. And it's real simple to calculate. You take the liabilities of the company and you divide it by the shareholder equity. Now, once you have that ratio, what does it mean? You need to be able to compare it to other companies that are similar to what you are interested in investing in. And if a company is outside of the certain parameters, then you might want to either investigate it or avoid it from that standpoint. The debt equity ratio with John Wiley and Sons is 0.99%. That's really pretty good when you compare it to other printing, publishing, and allied industries at 1.14. Remember, lower is actually better in this circumstance. Now, the current ratio is what we're going to look at next, and it actually indicates a company's ability to meet their short-term obligations. It's a real simple ratio to figure out, too. You basically take current assets divided by current liabilities, and that gives you a ratio. I'm, again, not to be too nerdy with you, but the word current is a big deal when you start looking this stuff up. Now, the numbers that come out with John Wiley and Sons comes out pretty favorable. They have current assets of around 477 million divided by their current liabilities at 634 million. So that puts the ratio at 0.75. Now that's just a little bit below what the industry average is. So that might, if I were investing a whole lot of money, I would probably be doing more investigation into this company and asking, why is that ratio below 1 when the industry average really is 1.2? Now let's talk about the actual numbers for the company and how they're making profits. This always confuses me, but different companies have fiscal years. That's FISCAL. It's the fiscal year. It's actually the year, the tax year that it begins, that their business begins in. Companies, let's say, for example, if you were going to be a college, you would probably have your academic year and your physical year similar. If you're Macy's, you might have your fiscal year after Christmas season when people sell stuff and buy stuff a lot. So the fiscal year for John Wiley and Sons actually began on May 1st, 2020. And yep, that was their 2021 fiscal year. So that's important to know. Now, the numbers that I'm going to give to you, I'm going to go through pretty quickly because those of you that are listening, I don't want you to get too bored on me. I do want to remind you that the numbers that I'm giving to you are unaudited, that come directly off of John Wiley and Sons website. And since we're talking about a fiscal year that began in May, we're talking about 6 months of time period in 2020. In revenues, their 2020 revenues were 466.2 million compared to their 2021 fiscal year, which was 491 million. So it's up about 5% in total. Now, looking at some other different numbers, I think that it's really important that you understand the revenues, but you also need to understand if a company is able to manage their cost and expenses well. And when we look at that for John Wiley and Sons, if we go back actually to the calendar year of 2019, we see that their costs and expenses were around $821 million. Compare that to the actual calendar year of 2020 at 822. That's only about 0.7% higher. That's really very good, friends, when we look at managing costs and expenses. Now, I want to point one thing out to you. If you are watching this and you're looking in the upper left-hand corner of the screen, you're going to see a word that says unaudited. That may change just a little bit. I don't think that it will, but I want to point that out because these are good numbers. So I'm going to anticipate that they are going to be audited and to be correct, but we have to put a codicil beside that. When we look at the actual earnings per common share for 2020, it was 79 cents, and that bumped up to $1.22 for the fiscal year of 2021. That is a 54% increase. Now, when I told you before that 80% of the revenues came from online learning, this is where a lot of their profits are coming from. They've actually done pretty good in dividends too, because look, I love dividends. I think that they're awesome. Now, I always use that musical interlude just to emphasize that dividends are an awesome thing, but we have to remember that dividends are not guaranteed. When we look at the 6 months of the 2021 fiscal year, they paid out in 2019 $38 million in dividends, and in 2020, it was 38 point. Now, I need to put these numbers into perspective, so if you're listening, that you understand what I'm talking about. In 2019, they had $38,486,000 in dividends. In 2020, which would be the 2021 fiscal year, they had dividends of $38,480,000. So that's a little bit less. But one thing that you don't see here is that in the previous year, they had treasury shares, which they repurchased. And after those treasury shares, that's when companies buy shares back. They don't have to pay more dividends out. So that's perhaps reason why that they've actually been reduced from that point. So that's good. Now, so what does that come out to tell you? It comes out to tell you that the dividends are 2.87%. And if you are retiring or retired, or you like dividend paying stocks, this is a good one to consider. But there again, friends, always remember that the past performance is not going to be a guarantee of future results. Now, I had to kind of reconstruct this myself, the next chart that I threw up here on the screen. And what I'm trying to do is give you an idea of what the earnings are for the company. Now, I'm not going to go through the exact numbers, but I just want to point out that if you're watching this, and those of you that are listening, let me describe this to you. There's a chart that goes back all the way to 2013 to 2021, and it shows the consensus of estimated earnings versus the actual earnings. And the chart kind of looks like, you know, a bumpy road in a way. It's not going up, which I really favor more, but it's also not going down. So what we're seeing is that there are some ups and downs. There's some divots in the road for profits. But on a regular basis, this company is actually exceeding what the consensus estimates are. And I think that's a good thing as we're looking going forward into the next year. But remember, always the past performance is not going to be a guarantee of future results. And I know, I'm sorry if I sound like a broken record, but I have to emphasize that anytime that you're putting money into stocks, it's kind of, that's why you're here, to do the research so that you understand what you're putting your money into. I'm not here to recommend stocks to you. I'm here to educate you about them. So let's actually look at what happened to the value of this stock over the past year and look at what happened to the dollars that were invested in it. Now, if you were going back in your time machine, your Wayback Machine, to January the 13th, 2020, the share price was at $47.50. Now, as I mentioned to you today, it actually ended at $48.49, but the number that I have up on the screen, I did these at lunchtime, so it's a little bit ahead of when the market closes. I used the number of 48.68, which actually shows that over a period of a year, the company grew by 2.5%. Now, remember that dividend of 2.87% is on top of the actual capital gains. Now, remember also that capital gains going into a new administration, And I want to talk to you just real briefly about this, because if this is your first time to listen to this, I want you to understand that why we're looking more critically at dividend paying stocks than we are ever before. If taxes change, which there's a good possibility that they will, there is a good possibility that capital gains are going to be taxed at a higher rate. Now, a capital gain is this. Let's say, for example, you buy a stock at $48 and it goes to $50. That $2 difference that's in there, that's a capital gain. Now, if you bought that $48 share and it paid a dollar dividend, that dividend is generally taxed to you as income and is going to be taxed in whatever tax bracket that you're in. Now, I'm not here to give you tax advice, but what I want to do is point out that if you are favoring putting money into investments that pay income rather than have growth through capital gains, this would be a good stock for you to consider. All right, so let's draw back the Wayback Machine just a little bit more and actually look what's happened with this stock over the past 5 years. Now, we always have to tell you that the past performance won't guarantee what's going to happen in the future, but it's good to be aware of what happened so you can kind of get an understanding of how this company operates. Now, if we're in the Wayback Machine and we are looking at this on, let's say, January the 16th, 2016, we see that the stock price back then was $39.38, a little bit higher than that, but 39.382. And as it ended up today, around 48.68, that's total gain over that 5-year period of 23.61% and an APR, that's annual percentage rate, of 4.33%. So it's not bad. It's not Tesla growth. But friends, I think that we've gotten spoiled. We've gotten spoiled by the FANG stocks, the Facebook, Amazon, Google, all those stocks that are out there that have had significant growth. You have to ask yourself, though, that going forward in the new year, if they're going to continue like that. Now, there are other good companies out there, and that's why I want to bring to you information about a company like John Wiley and Son. I had one of our listeners that made a comment that I was actually flattered by. He said, I'm really glad that you're talking about some of these companies that we're not as familiar with, rather than just always talking about Amazon and Tesla and Google and Facebook and Twitter. Well, yeah, listen, there are other companies out there, friends. There's a lot of them. And even though that this company is only about $2.67 billion, it's still a good, well-managed company. So let's look a little bit further at it and see what we can learn as we go forward. Now, when you look on a company's website, and if you've never done this, go to a company's website and go to the section that says investors. A lot of times you've got to go all the way down to the bottom of the website, down into their junk drawers, what I call it, the bottom of the website, and you got to find the icon that says investors, and you click on that. After you read through it, you will probably find something that talks about guidance. Now, guidance, it's important to remember, guidance is not a guarantee. This is just what a company thinks that they will do. Now, there are a lot of companies right now, because of the pandemic, that have declined to offer guidance. Actually, Apple was one of them that declined to offer guidance because they weren't really sure what was going to happen. But when we look at John Wiley Sons, John Wiley Sons did offer guidance on their investments, on their stocks going into the next year. Their EBITDA, now not to be too geeky again, but that's the earnings before interest, taxes, depreciation. They're saying their earnings and all that is going to go between 6.7 and 10.96%, which is actually pretty good. Now, as well, I remind you that guarantees aren't guaranteed in this. Okay, there are no guarantees. I want to take just a real brief moment and talk to you about one of our sponsors. Our sponsor is adviceforlifeinsurance.com. And if you need life insurance, you can find the best life insurance at the lowest price in less than 5 minutes. go over to adviceforlifeinsurance.com and they can help you out. All right, now let's talk about the bullish aspects of what is being said about John Wiley and Sons. Now, what you're going to find, though, with smaller companies is that there's not a lot of analysts that are covering it. Actually, Morningstar is really the only one that's offering very much information that's current. There are 3 other companies we're going to talk about in just a moment. But the analysts out there right now, from a bullish standpoint with John Wiley and Sons, are saying that journals are critical to libraries and academic research. And that's one of the biggest bullish aspects. It can't be replaced, or it's very difficult to replace it, let's say. The pandemic has pushed forward the use of online learning, and John Wiley and Sons, as I mentioned earlier, where 80% of their revenues in the past year has come from online programs, has benefited from this, and they probably will continue to go forward. They also have long-standing relationships with universities, which are really hard to get. It's not like that there can be competitors out there that can get that. But with every investment, there's not going to be just a bed of roses. There are bearish aspects out there too. Let's look at the reality, friends. The economy with the pandemic has stretched a lot of budgets. Libraries, museums, all of those different types of institutions are having their budgets really stretched. And if libraries have stretched budgets, they may not be able to invest as much, and that can hurt the type of journals that they carry because they can't afford it. So that will affect John Wiley and Sons to possibly going forward. Another threat is open source publishing. And if you're not familiar with this, there is a resource which is called OpenStax. And I believe it was actually begun by Bill and Melinda Gates. And it's where volunteers, academic volunteers, actually write books and they make them available for free. That could really hurt the margins over at a company like John Wiley and Sons. But you have to keep in mind, too, that the type of books that are being written, it's not competing with journals yet. So it could be some competition, but not in total. Now, there's also a reduction in printed material, which does reduce revenues. Most of what their profits are and have come from online resources, but there is still a portion of it that's from the actual printed book in itself. But those are becoming less and less as we look forward. Now, what does Morningstar say about this company as far as like their fair market value? Morningstar's opinion is that John Wiley and Sons fair market value right now is at about $45. Their current value, I know I put up 48.71 here. They closed at about 48.49. That's still about the same. They're about 8% overpriced according to Morningstar. Now, as I mentioned earlier, there are not a lot of analysts out there that are offering opinions on John Wiley and Sons. So what do? We have to take what we have and then use information like what I've given to you and then what you research to determine whether this would be a really good investment. Is a 2.87% dividend interesting to you? Is a moderate growth from a stable company interesting to you? If it is, then take this information and use it how you will to make your decisions. But when we look at what other analysts are saying, the last analyst that offered an opinion was called Sidoti, S-I-D-O-T-I, and they initiated coverage on January 24th, 2019, and there hasn't really been an update. We have to go back to 2018, and we see that Stifel and CJS Securities at that point offered some opinions too, but I'm not going to put a lot of credence in these from that standpoint. Take the information that I gave you and take also the information that you may be seeing from Morningstar and make your opinions based on what your own research is. Okay, remember we looked at the stability, the earnings, and now how competitive is this company? There's not really a lot of companies out there that compete with John Wiley and Sons. They are small, but they don't have a lot of competitors. At $2.73 billion and a 2.87% dividend, the closest competitor is going to be Pearson. Now, Pearson is a It's an English company from Great Britain. The company is bigger than John Wiley and Sons, but not much. They're at about 6.9 billion. And they have actually, if you're not familiar with Pearson, Pearson has a different market where John Wiley and Sons may be more for graduate and doctorate research. Pearson will go more for the competition with the open stacks. Pearson is going to compete more. But we can't deny the fact that if you're looking at the spaghetti graph that I threw up on the screen, now if you're just listening to this, what you're seeing is you're seeing the graph of what's happened to John Wiley and Sons compared to Pearson. And Pearson has actually beat them hands down, where John Wiley and Sons only got about a 2.5% growth over the past year. Pearson has actually got over 15%. So they have beat them. So keep that in mind, though. If you're interested in Pearson, look a little bit more closely at where their revenues are coming from, kind of the same way that we did with John Wiley and Son. Now, another company that is a competitor is Scholastic, but also there again, they are an online publisher of educational material, but it's different. Scholastic is going to be, more of the elementary, middle school type books. So they're not even competing from that standpoint. So I would say John Wiley and Sons and Pearson are really the two biggest companies out there right now. And when we wrap all this up, I just want to remind you, we're looking at the stability, the earnings, and the competitiveness. And then what your job is as the investor is going to be to ask yourself, is this information enough for me to make a decision on whether I should buy, sell, or pass on this particular investment? I hope it's been helpful to you, friends. And if you have a stock that you're interested in, I would be glad to take a look at it. Now, I can't take everybody's request because there's a lot of people that listen and there's a lot of requests, and there's 5,000 stocks in the world or more, and it'd take me about 13 years to cover every single one. But if you have a stock in mind and you'd like me to take a look at it, I will, and I'll see if I can put it into the program. So I want to remind you also that coming up next is going to be the disclaimer, which is really important, the disclosure that tells you the limitations of everything. So with that, I want to say thank you for listening, and come back and listen again tomorrow. Go back and listen to some other recordings that I've made, and let me know what you think. Have a good evening.